So let's look at an example. If you decide to go with passive investing, for example, so to go with the passive investing, let's assume that we want to invest in 100% equity and we are looking at doing that with an index fund or an ETF. So this table shows you the different uh, available options. We want 100% portfolio that is invested across the world, not just the UK, not just the US, but across the world. Now, here, what we are doing is we have 6 options here and they have different names. For example, the first one is HSBC 40 All World Index Fund. But on the right hand side, you can see what we call the cost in percentage. This costs you 0.13% on a yearly basis. Then next to it, you can see the amount of money the fund is currently having. Then next to it, you can see the number of shares that each fund is holding. So for example, the index fund, for example here, the first one, the HSBC 40 All World Index Fund, has about 3,520 different companies in that fund. So it means that if you buy one unit of this fund, you are investing in 3,520 companies. So if something happened to one of those companies, you won't really feel it, because you have others to support or to back you up. Now, if you invest in this first fund, for example, in the 1 year ago, it went up by 20%. Remember, the graph that I showed you previously was on an annualized up growth of 5. But this one went up by 20% within the last 1 year. Within the last 3 years, it went up by 12.15%. And within the last 5 years, it's gone up by 11.49%. And then the risk level on a scale of 7, they rank it as 5/7. Then there's another one called SPDR MSCI ACW ETF. This one has a slightly lower cost, 0.12%, and it's holding a slightly smaller number of holdings, about 2,000 shares. Then the 1 year performance is around 19.83%. It's not as close to 20, but it's not too far off. Then if you look at you can also check the 3 years and 5 years performance. There's another one called the iShare MSCI ACWI ETF. Now, if you look at this, there are 2 things that are very important. If you want to invest in the top companies in the whole world, there are 2 index that follows that. One is the FTSE, the other one is the MSCI index. So depending on the index, you can see the name of the index in the fund. So the second one is MSCI, the third one is MSCI, and the next 3 are all FTSE based fund. And the first name that you see is the platform that owns the fund. So for example, HSBC FTSE is owned by HSBC, SPDR is owned by SPDR, iShares is owned by iShares, Vanguard is owned by Vanguard, Invesco is owned by Invesco, another management company. Okay, so you can check the fund cost and you can see they are very close to each other, but they can make a lot of difference. Then the next thing you want to check is how much of shares do they hold. For example, the Vanguard FTSE Global All Cap Index Fund, which is a highly recommended fund, charges 0.23%, and it owed about 7,105 different companies within the fund. And you can see the value of the fund is like £5 billion. Okay, and look at the annual return in the last 1 year, 18.86. In the last 3 years, 11.41. In the last 5 years, 10.79%. So you can see the higher the return, it shows you that the better the performance of the fund. But at the same time, you need to check the cost, because sometimes the cost can eat into whatever you are getting. So let's look at an example that considers cost. So if you look at, for example, I have done a brief calculation here over the 1 year return. So for example, the first fund, the HSBC 40 All World Index Fund, it has an ongoing charges of 0.13%. In the last 1 year, it has gone up by 20.54%. Now, 20.54%, if you invest £1,000 in this fund, it means that you will get a return of £205.4. Now, this 205.4 205.4 will be added to your original investment. So you now have 1,205.4. Then on top of that, you now need to charge your fee. So which is 0.13% of 1,205.4. If you do that, the charges for that year for the first fund is 1.57%, 1.57 pounds. So it means that the balance after the first year, if you take into the account the charges, will now be 1,203.83. So you can see that higher return has an impact and lower cost also has a benefit. So at the end of the day, I did this for each of the funds and then I ranked them from 1 to 6. And you can see the first one, which is the HSBC 40 All World, has the best return within 1 year. So we have 1,203.83 if we invested £1,000. But then the second performing one is a new fund, which is the Invesco 40 All World ETF. It charges 0.15%. But what really made it second is because of the performance. So it went up by 20%. Okay, it went up by 20% in a given year. And by it going up by 20%, for example, it means that, so by going up by 20%, it's 20.32%, it means that it can easily absorb the higher cost compared to the others. So if you look at the end of 1 year, this fund becomes 1,201.50 pounds. Now, if you look at it, the first one has the highest balance after 1 year. The sixth one has the next highest, and then you can rank the others. And you can see there is not a lot of difference, but in 1 year. But if this happens over 10 years, over 30 years, you can see that these things come together to, make a lot of difference. And that is why if you are choosing your fund, make sure that the charges is as low as possible, but also check the performance. Of course, we always say past performance is not a guarantee of future performance, but if you cannot control the performance, but you can control the charges. So if the charges is low, then you can be sure that there is only a little thing that will be taken out of your profit at the end of the day. So by ranking this, if I want to choose, I will go with the first one. Now, if I say this is the fund I want to invest in, the HSBC 40 All World Index Fund, because of the performance as I can see, and I say, okay, this is what I want to invest in. But the question is, I want a platform that doesn't charge me a lot of money. So I need to check how much will HSBC charge me to hold this fund. This is apart from the cost of the fund itself. If HSBC will charge me £1 per month, then I check, okay, which other platform? For example, Vanguard will charge me £4 per month. So if I put it in comparison, I would say, well, it's better to hold it in a place that charges less than £4. But then I can also check, can I find it on, for example, Trading 212 or Free Trade that charges £0 per month per year? So it means that if I really want more of my money in my pocket, I might be better off choosing a platform that doesn't charge me any money to invest and choose a fund that has the lowest expenses or cost on a annual basis as my own investment fund. So these 6 funds that I have here, they are invested across the world on big companies, small company, and so on. So they are all across the world. Now, if you choose, for example, let's choose the second one, second position, because again, you don't always have to choose the best one. You choose based on whether the platform that you want to use has the fund. If it doesn't, then you go to the next best one. Again, you have to make that judgment call yourself. So if I choose the second one and I check what are the top 10 holdings of this fund, and as you can see on the screen, I have the number one is Apple. So in terms of percentage, over 100%, this fund has 4.22% of Apple. So it means that if I invest in this fund, I am also investing in Apple. If I invest in this fund, I'm investing in Nvidia, Microsoft, Amazon, Meta, Alphabet, Broadcom, Tesla, Alphabet, and also Taiwan Silicon Manufacturing Co. TSMC. So you can see that this fund has US, UK, has Taiwan, has China, has Hong Kong, has everything in it because it's all across the world. So it means that even if anything happens to economy in the UK, then the other economy will do better or can do better to offset that. So we always suggest invest all world, all cap, such that if anything happens to any of those companies, it doesn't impact you negatively.